Hello and welcome to our YouTube channel, The Loophole Why. Every recession makes billionaires richer, while millions lose their jobs. Their homes, their futures, a small group of people do the opposite. They get wealthier, not by luck, not by accident, but by design. How does economic collapse become a goldmine for the ultra-rich? Every major recession in modern history, from the Great Depression to the 2008 financial crisis to the COVID-19 downturn, follows the same pattern. The wealth gap explodes. The richest 1% walk away with more. The rest struggle to recover what they lost. This isn't about conspiracy. It's about structure. It's about how money, power, and timing create opportunity during chaos. And right now, with economic uncertainty rising around the world, it's happening again. The pattern begins in 1929. The Great Depression wipes out fortunes for ordinary Americans. But families like the Kennedys and Rockefellers buy assets at rock-bottom prices. Forbes Historical Analysis, 2019. They turn crisis into generational wealth. Fast forward to 2008. The housing market collapses. Lehman Brothers falls. Unemployment hits 10%. U.S. Bureau of Labor Statistics, 2009. Families lose homes. Retirement accounts vanish overnight. But behind the scenes, something different happens. Private equity firms and wealthy investors sweep in. They buy foreclosed homes in bulk. They purchase struggling companies. They acquire real estate at 30, 40, 50% discounts. Wall Street Journal, 2010. By 2010, billionaire wealth rebounds completely. According to Forbes, billionaire net worth returns to pre-crisis levels within 2 years. Forbes Billionaire List, 2010. Meanwhile, median household wealth takes a decade to recover. Federal Reserve Economic Data, 2020. Then comes 2020. A pandemic shuts down the global economy. Small businesses close forever. Unemployment surges to levels not seen since the Great Depression. International Labor Organization, 2020. 40 million Americans file for unemployment. U.S. Department of Labor, 2020. Yet during those same months, U.S. billionaire wealth increases by over $1 trillion. Americans for tax fairness, 2021. Amazon, Zoom, and tech stocks soar. Jeff Bezos adds $70 billion to his net worth. Bloomberg Billionaires Index, 2021. Elon Musk's wealth multiplies 5 times over. The mechanism is documented across decades of economic research. When recession hits, asset prices collapse. National Bureau of Economic Research, 2008. Stocks drop. Real estate plummets. Businesses sell at desperate valuations. People with cash reserves can buy. People without cash must sell, according to Federal Reserve data. The top 10% of Americans own 89% of all stocks. Federal Reserve Survey of Consumer Finances, 2022. They have the liquidity to invest when others cannot. Central banks respond to recession by lowering interest rates and injecting money into the financial system. Federal Reserve Historical Actions, 2008 to 2020. This quantitative easing, as it's called, floods banks and markets with cheap money. It's designed to prevent total collapse, but that money doesn't reach everyone equally. Research from the Rand Corporation found that from 1975 to 2020, $50 trillion shifted from the bottom 90% to the top 1%. Rand Corporation, 2020. Much of that transfer accelerated during and after recessions. The pattern is clear in corporate behavior too. During the 2008 crisis, major banks received bailouts totaling $700 billion. U.S. Treasury TARP program, 2008. Those same institutions then foreclosed on millions of homes. They emerged larger and more profitable than before. Financial Crisis Inquiry Commission Report, 2011. Some economists argue this wealth concentration is temporary. They point to market cycles and eventual recovery. The argument suggests that Risk-takers who invest during downturns deserve the rewards. American Enterprise Institute Commentary, 2021. Others contend the system itself is broken. They cite policy choices, tax structures, and regulatory capture as root causes rather than natural market forces. Institute for Policy Studies, 2020. The debate centers on whether inequality results from capitalism's design or from corrupted implementation. There's disagreement, too, about solutions. Some advocate for stronger safety nets and progressive taxation. Others warn that intervention distorts markets and reduces growth. What remains disputed is whether the current trajectory is sustainable or if it risks broader instability. For ordinary families, recession means real suffering. Parents skip meals so children can eat. Graduates with new degrees move back home, unable to find work. Medical bills pile up because people delay care they can't afford. The psychological toll runs deep. Studies document increases in depression, anxiety, and substance abuse during economic downturns. American Psychological Association, 2008. Relationships strain. Divorces increase. Communities that lose major employers often never fully recover. Meanwhile, billionaire wealth operates in a different universe entirely. $1 billion generates roughly $50 million per year in conservative investment returns. Even during recession, even losing half their wealth, billionaires remain billionaires. They don't choose between rent and groceries. They choose between estates. Think of the economy like a poker game. Everyone starts with chips. But when crisis hits, most players must cash out their chips to survive. They sell at whatever price they can get. The players with the biggest stacks wait. They buy everyone else's chips at a discount. When the game recovers, they own most of the table. This isn't just about numbers on a screen. Wealth equals power. Power shapes policy. Policy determines who benefits when the next crisis arrives. According to Princeton University research, economic policy in the United States correlates strongly with preferences of the wealthy, not the median voter. Gillens and Page, Political Science Quarterly, 2014. The cycle becomes self-reinforcing. Each recession concentrates wealth further. That concentrated wealth buys influence. That influence shapes the rules. And those rules ensure the next crisis follows the same pattern. It's a flywheel of accumulation that's been spinning for a century. We know recessions destroy wealth for most people. We know they create opportunity for those with capital. We know the pattern has repeated across every major economic crisis in modern history. What we're still grappling with is whether this outcome is inevitable or whether it represents choices we've collectively made and could unmake. The question now isn't if another recession will come, but when, and what happens next time. In the near term, economic indicators suggest continued volatility. Central banks worldwide are managing inflation while trying to avoid recession. International Monetary Fund World Economic Outlook, 2024. Confidence level high if recession does arrive. The pattern suggests wealth concentration will accelerate again unless structural changes occur. Those changes could include tax reform, stronger antitrust enforcement, or new regulations on asset acquisition during crisis. Confidence level medium for continued pattern, low for major reform. The wild card is public awareness. More people understand the pattern now than during previous cycles. Whether that awareness translates to policy change or social movement remains uncertain. Confidence level low for near-term impact, medium for long-term shift. Every recession is a transfer of wealth from those who must survive to those who can wait. Understanding the pattern is the first step toward changing it. If you want to understand how this connects to the broader story of inequality, watch our next video. The real reason wages haven't grown in 40 years. It picks up where this one leaves off. Source notes and disclaimer. **** This script draws from peer-reviewed economic research, government data, and reporting from established financial publications including Forbes, Wall Street Journal, Bloomberg, and academic institutions. Economic patterns described reflect documented historical trends. Situations remain fluid, and this analysis represents conditions as of late 2024. For updated information, consult current economic data from Federal Reserve and IMF sources.